There's a number on your credit card statement that looks responsible. It's called the minimum payment. And mathematically, it might be one of the most dangerous numbers in personal finance. Imagine you have a $6,000 credit card balance. Your statement says the minimum payment is about $120. That feels manageable. You pay it every month. You're doing the responsible thing. You're staying current. You're not missing payments. But here's the strange part. After months of paying, the balance barely moves. Because most of that $120 isn't paying down the debt at all. It's paying interest. So the debt shrinks slowly, while the total cost quietly grows. And over time, that small, harmless-looking number can turn a few $1,000s of debt into something much bigger. So today, we're going to unpack why minimum payments aren't a safety net. They're a financial time bomb. Today, I'm going to show you what minimum payments actually do behind the scenes, why the math of credit cards traps so many people for years, and why this system is structured the way it is. Because when you only look at the monthly payment, the numbers seem reasonable, sometimes even small. But once you look at the full timeline, the interest, the payoff period, and the total cost, the picture changes completely. By the end of this video, you'll understand the real cost of minimum payments, how a few $1,000s of debt can quietly turn into 2 or 3 times that amount, and why so many people stay stuck in credit card balances much longer than they expect. And more importantly, you'll see exactly how to avoid this trap and start shrinking that debt much faster. My name is John, and I spend way too much time thinking about how debt, interest, and financial systems quietly shape people's long-term wealth. If you're someone who's trying to get control of credit cards, pay down debt, or just understand how the numbers actually work, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now, to understand why minimum payments are so dangerous, we first need to look at how they're actually calculated. Here's what most people don't realize about minimum payments. They're usually incredibly small compared to the actual balance. Most credit cards calculate the minimum payment as somewhere between 1% and 3% of the total balance, sometimes plus the interest that accrued that month. So when you look at your statement, the number feels manageable. It feels like something you can comfortably fit into your monthly budget. And psychologically, that matters a lot. Human behavior tends to optimize for what feels manageable today, not what minimizes long-term cost. When the payment is small, the brain registers it as a controlled situation. You think, okay, this isn't great, but it's under control. But the math underneath that payment tells a very different story. According to data from the Federal Reserve, the average credit card interest rate in the United States has recently been hovering around 20% to 24% APR, depending on the card and credit profile. That interest rate becomes extremely important once you look at how payments are applied. Let's walk through a simple example. Imagine you have a $5,000 credit card balance with a 22% annual interest rate. On a balance like that, your credit card statement might show a minimum payment of around $125. At first glance, that feels like progress. You paid something. The balance should go down. But here's what actually happens. Interest is applied before your payment reduces the balance. At 22% APR, that $5,000 balance generates roughly $90 in interest in a single month. So when you make that $125 payment, the first $90 disappears immediately into interest. Only about $35 actually reduces the balance. You paid $125, but the debt moved only $35. Next month, the process repeats. Interest first, then whatever tiny amount remains goes toward the balance. And this is why minimum payments create such a powerful illusion of progress. You're making payments every month. You're doing what the statement tells you to do. You're technically staying responsible and avoiding late fees. Emotionally, it feels like you're moving forward. But mathematically, almost nothing is happening. The balance shrinks incredibly slowly, while interest keeps taking its share every single month. So the system quietly stretches a relatively small debt across years, sometimes decades, without it feeling dramatic in the moment. And once you understand that mechanism, the next question becomes obvious. Why is the system designed this way in the first place? Now watch what happens when we zoom in on how credit card interest actually works. Because the real trap isn't just the interest rate, it's how that interest is applied over time. Credit cards typically calculate interest daily. The balance accrues a small amount of interest every single day, based on your annual percentage rate, and then that interest is applied to the account at the end of the billing cycle. That structure matters a lot. Let's go back to the example. You have a $5,000 balance on a credit card with a 22% APR. Over the course of 1 month, that balance generates roughly $110 in interest. Now imagine your statement shows a minimum payment of $125. You make the payment. You feel like you're chipping away at the debt. But here's what the math actually does. The first $110 goes straight to interest. That leaves $15 to reduce the balance. You paid $125. Your debt moved $15. And next month, the cycle repeats again. Interest is calculated on the remaining balance, added to the account, and then your payment mostly covers that interest before touching the principal. This creates a very strange financial dynamic. From a behavioral perspective, everything feels normal. You're making payments every month. You're staying current. The account isn't going to collections. You're technically following the rules. That creates psychological relief. But mathematically, almost nothing is changing. The balance shrinks so slowly that the timeline stretches dramatically. What looked like a manageable short-term debt quietly becomes a long-term financial drain. And this is why minimum payments are so deceptive. They give the appearance of progress without actually producing much progress. An easy way to think about it is like running on a treadmill that slowly moves backward. You're putting in effort. You're sweating. You're moving your legs. But the machine underneath you is working just hard enough to cancel most of that effort out. So you stay roughly in the same place for a long time. Now, to be fair, minimum payments do serve one purpose. They prevent accounts from going into default. They keep borrowers technically in good standing with the lender. But they do almost nothing to aggressively eliminate the debt. And this is where the bigger picture starts to emerge. Because once you see how slowly the balance actually moves, the next question becomes much more interesting. Why are minimum payments designed to be so small in the first place? And the answer to that question reveals something about how the entire credit card business model works. This is the part nobody talks about. Credit card companies are not primarily in the business of issuing plastic cards. They're in the business of earning interest on revolving balances. And that distinction explains a lot about why minimum payments exist the way they do. Every year in the United States, credit card companies collect well over $130 billion in interest payments. That number fluctuates slightly year to year, but the scale is enormous. And that revenue mostly comes from one group of customers, people who carry balances month to month. These are called revolving balances. If you pay your credit card in full every month, the bank usually earns very little from you. Maybe some interchange fees from merchants when you swipe the card, but the big money isn't there. The real profit engine is long-term interest payments. So the ideal customer, from a credit card company's perspective, is someone who does two things. They make their payments on time, but they don't eliminate the balance quickly, because that combination keeps the account active while interest continues to accumulate, and minimum payments help maintain that balance. Think about what would happen if the minimum payment were much larger. If credit card statements required people to pay 20% or 30% of the balance every month, many borrowers would struggle to keep up. Defaults would spike. Accounts would go delinquent more frequently. That's not good for the system. But if the payment is very small, the opposite happens. More people can stay current. Accounts remain open. Balances linger for years. Interest keeps flowing. Minimum payments are essentially designed to strike a balance between two competing outcomes. On one side, lenders don't want borrowers to default. If someone stops paying entirely, the bank may lose money. On the other side, lenders also don't want balances disappearing too quickly because that ends the interest stream. So the minimum payment sits in the middle. It's just large enough to prevent widespread defaults, but small enough that the balance can stretch out over a very long period of time. From a system perspective, that makes the credit card market remarkably stable. Borrowers stay afloat. Banks continue earning interest. Accounts remain active. It keeps the system stable and profitable. Now, none of this means credit cards themselves are inherently bad. They're tools, and tools can be used well or poorly. But once you understand how the incentives work, the next piece becomes much more important. What does this structure actually do to the total cost of a typical credit card balance over time? Here's where it gets really interesting. Because once you stretch this system out over time, the numbers start to look very different from what most people expect. Let's walk through a realistic example. Imagine someone has a $6,000 credit card balance with an APR of 22%. That's a pretty typical interest rate for many cards today. Now assume the card requires a minimum payment of about 2% of the balance each month. At first, that payment might land somewhere around $120. That number feels manageable. It fits into the monthly budget. It doesn't cause immediate panic. So the person keeps paying the minimum, month after month, year after year. But here's what the long-term math actually shows. If someone only pays the minimum on a $6,000 balance at 22% interest, the payoff timeline can stretch to roughly 30 years. 30 years. And during that time, the total interest paid adds up to more than $9,000, which means the total amount repaid isn't $6,000. It's over $15,000. You borrowed $6,000 and end up repaying more than 2.5 times that amount. Now, when people hear numbers like that, the reaction is usually surprise, because it doesn't feel like that much money while it's happening. And that's the key to why this system works so effectively. The payment is always small. The timeline is always invisible. You don't see a giant bill that says you will pay $9,000 in interest. Instead, you see a manageable monthly payment, $120, then maybe $118, then $115. The number slowly changes as the balance moves, but the time horizon disappears into the background, and that's where the cost hides. Think about what $9,000 of interest actually represents in real life. That's several vacations. It could be a reliable used car. For some people, that's several months of rent. It's a meaningful amount of money. But instead of appearing as one large expense, it gets sliced into hundreds of small pieces over decades. And when expenses are spread out like that, our brains tend to underestimate them. Here's the dangerous assumption most people make. They assume minimum payments represent progress toward eliminating the debt. But in reality, minimum payments are mostly designed to maintain the balance while interest keeps working. The debt eventually disappears, yes, but the timeline stretches so far into the future that the interest quietly becomes the dominant cost. And once you see the numbers laid out like this, a much more interesting question starts to appear. What would happen if someone simply changed the payment strategy, even a little, because the difference between minimum payments and slightly higher payments can completely change the timeline? Now let's look at what happens if you do something slightly different. Because the interesting part of this story isn't just how minimum payments stretch debt out, it's how small changes in payments can dramatically change the timeline. Let's go back to our example. You have a $6,000 credit card balance at 22% interest. The minimum payment is about $120 per month. If someone follows that minimum payment schedule, the math stretches the payoff timeline to around 30 years, with more than $9,000 in interest paid along the way. But now let's change just one variable. Instead of paying the minimum, imagine that person commits to paying $250 per month. That's a little more than double the minimum payment. Not a massive number. But watch what happens to the timeline. Instead of 30 years, the debt disappears in about 3 years. 3 years. And the interest paid over that period drops dramatically, from more than $9,000 to only around $2,000. That means thousands of dollars simply disappear from the cost of the debt. Nothing magical happened. The interest rate didn't change. The bank didn't renegotiate the terms. You simply stopped feeding the interest engine for decades. Instead of letting interest dominate the payment, a larger portion of each payment began attacking the principal balance. And once the principal starts shrinking faster, the entire system flips. Less balance means less interest next month, which means more of your payment goes toward the balance, which means the balance falls even faster. This creates the opposite dynamic of the minimum payment trap. Instead of being stuck in a slow loop of interest, the debt begins collapsing much more quickly. And this is where the psychology changes too. Minimum payments put you in survival mode. You're maintaining the debt, you're keeping it under control, but you're not really eliminating it. A fixed, aggressive payment, even if it's just somewhat larger, puts you in progress mode. Now every month actually moves the needle. And that small psychological shift is often the difference between carrying credit card debt for decades or removing it from your life entirely. Now, you might be thinking, I only use credit cards for emergencies. And on the surface, that sounds reasonable. Credit cards are often positioned as a financial safety net, something you use when a car breaks down, a medical bill appears, or an unexpected expense hits your budget. The problem is what happens after the emergency. Let's say a $3,000 repair goes on a credit card. If that balance then sits at 22% interest and only minimum payments are made, that emergency doesn't stay a $3,000 problem. Interest slowly multiplies the cost. A temporary situation quietly becomes long-term debt. And because minimum payments stretch the timeline so far, what was supposed to be a short-term bridge can end up lingering for years. Now you might be thinking, at least I'm building credit. And this is another common misunderstanding. Carrying a balance is not what improves your credit score. Credit scores are mainly driven by a few factors: your payment history, whether you pay on time, your credit utilization, how much of your available credit you're using, your length of credit history. But none of these require you to carry interest-bearing debt. In fact, someone who uses a credit card regularly and pays it in full every month often builds credit just as effectively, sometimes more effectively, than someone who carries a balance. So the idea that you need to keep debt around to build credit isn't really accurate. The system rewards responsible use. It does not require long-term interest payments. Here's the dangerous assumption behind minimum payments. Most people assume that if they're making the payment the statement asks for, they're doing enough. From a behavioral perspective, this makes sense. Humans tend to optimize for monthly comfort. not long-term math. When a bill arrives and the required payment is small, the brain interprets that as manageable. The problem feels contained. You pay the number the statement gives you. You check the box, and mentally, the situation feels handled. But the minimum payment has a powerful psychological effect. It acts like permission. It quietly tells your brain, you're doing enough. You're staying responsible. You're following the rules. But financially, something very different is happening. The debt is barely shrinking. Interest continues accumulating in the background, and the timeline quietly stretches further and further into the future. So while the monthly payment creates a sense of progress, the math underneath it often means you're standing almost exactly where you started. So if minimum payments are the trap, the obvious question becomes, how do you get out of it? The good news is the solution is usually much simpler than people expect. It just requires a shift in how you approach the debt. Here are 4 practical steps that make a huge difference. Step 1. Calculate your real payoff timeline. Most people never see the full timeline of their credit card debt. They just see the monthly payment. Take your current balance, your interest rate, and plug it into a credit card payoff calculator. Look at how long it would take to eliminate the debt if you only paid the minimum. For many people, the answer is shocking. Sometimes it's 15 years, 20 years, even 30 years. And seeing that number clearly can change how you approach the problem. Step 2. Set a fixed payoff target. Instead of letting the bank control the timeline, pick your own. A common goal is 3 years. Now the question becomes simple. What monthly payment eliminates this debt in 36 months? That single shift turns a vague financial burden into a clear, measurable objective. Step 3. Automate payments above the minimum. Automation removes friction. Set your payment to automatically send more than the minimum every month. Even an extra $50 or $100 can dramatically accelerate the payoff timeline. Remember, once the principal starts shrinking faster, the interest calculation begins working in your favor. Step 4. Stop adding new balance while paying it down. This step is critical. If the balance keeps growing while you're trying to reduce it, the math never flips in your favor. That often means temporarily reducing credit card use, switching to debit, or budgeting more tightly while you eliminate the balance. And this is the part people don't love hearing. Debt freedom usually requires a short period of intensity. It may mean fewer discretionary purchases, tighter spending, or redirecting extra income toward the balance. But that short-term sacrifice buys something incredibly valuable. A future where the interest engine is no longer quietly draining your money every single month. Now zoom out for a moment and imagine 2 different futures. Person A carries a credit card balance and pays the minimum every month. The payment is manageable, so it never feels urgent. Years pass. The balance slowly shrinks, but the interest keeps taking its share. The payment becomes just another permanent bill in the monthly budget. Nothing catastrophic happens, but nothing really improves either. The debt just quietly exists in the background for a very long time. Now compare that to person B. They look at the same balance and decide to eliminate it aggressively. They increase the payment, focus on it for a few years, and eventually the balance disappears. Once that happens, something important changes. The monthly payment that used to go toward the credit card suddenly becomes free cash flow. That money can now go toward savings, investments, building an emergency fund, or simply creating more financial breathing room. And this is the part that often gets overlooked. The real cost of minimum payments isn't just the interest. It's the years of financial momentum you lose. While that payment sits in your budget doing nothing, but servicing old debt. So when you look at the minimum payment on a credit card statement, it's easy to think of it as the responsible option. But once you understand the math behind it, you realize something important. The minimum payment is designed to maintain the debt, not eliminate it quickly. And the moment you take control of the timeline, even by increasing the payment a little, the entire equation changes. If you currently have credit card debt, try this. Comment your balance below. If you're comfortable sharing it, I'll reply and give you a rough estimate of how long it might take to pay off depending on the payment strategy. And if this video helped clarify how this system works, make sure to hit the like button and subscribe for more videos where we break down the math behind everyday financial decisions. My name is John, and I'm not a financial advisor. This video is for educational purposes only. Always do your own research and make financial decisions based on your individual situation.